Well, hello, you trader nerds, and all of my students at the wonderful University of West Georgia. I love y'all. Y'all are doing so good, and I'm so proud of y'all. So good to see you here. We're going to do a little bit of, oh my God, the market's crashing. Hello, what's happening? Look at this, y'all. Look at this. Isn't it great? What's happening in the market? So welcome in. Good to see everybody. Hope you're having a wonderful, wonderful week. It is Thursday, and it is time for us to do a little bit of trading. And my West Georgia class has a assignment to sell a put. So we will show you how to sell a put today. But before that, I want to go into a little bit of portfolio management. Looks like the market is a little bit, it's about average volume. That's the number of shares traded every 2 minutes. It's 5,100 contracts on the E-minis. This is the S&P 500 futures. This is where we opened today at 49.19. This was the overnight high at about the 49.20. These are different pivot points. This is valuated average price. The gray area is the opening 15 minutes, the opening 15-minute range. And now, for some reason, we are going downward. The VIX is the fear index. That's volatility. Remember, we said that volatility in life is overstated. Remember the going to the beach and you thought you were going to drown, but you didn't drown, right? The volatility was overstated, unless it was my sister-in-law who passed away and the volatility got her. But most of the time, volatility is overstated and always comes back. So VIX is the volatility of the S&P 500, SPX over a 30-day period. So it's at 13.55. The advancers over decline is 201. That means nothing to you now. That's fine. Let's look at the big green monster really quick. Big green monster is, where is my big green monster? Come here, little baby. There we are. So kids at West Georgia, this means nothing to you yet. I shouldn't call you kids, young adults. This means nothing to you yet. But remember yesterday we said we are going, ladies and gentlemen, to the 49.66. We are going to the 5,000. But there are pockets of volume. This is volume. Think of this is where the most trades have occurred over the last 10 days. So nobody has traded here. And the market loves to go back to those areas. It's like a little vacuum, y'all, and it wants to go to that. So we see a gravitational pull of the market here, but we will go up at some point, but it looks like it may want to go down to there first. So we shall see. Nature doesn't like a vacuum. Black holes suck everything up. Same thing with this. This is a black hole that kind of sucks down and brings price back down to it where volume was wanting to be tested. Okay, so with that being said, let's go to let's do this account. We've been trading a lot of different accounts, and remember this is the mega account. So let's see how we're doing. We hadn't looked at it in a week, so let's see if we're up or down. So we're at 125.24, and let's see what the net liquidation value is. If you hear me say net lick, that just means the account value, right? It's the value of the account. So let's see that really quick and we are at 463,943. 463,943. 46. Good Lord, what is on that garbage? Who the crap is Chris? 463,932. 463,932. So let's put that in there. 463,932. Where's my trades? Here we go. 463,932. 463,932. Fire up the band, Rico.
Well, we're moving on now. Moving on to the side. To a deluxe apartment in the sky.
All right, so we have made $4,561 since January 1st. Since we looked at it last week, y'all, we are up $2,500. We are up 1% on the year. Doesn't sound too good, but we don't have this account built up yet. We're trying to get 20% a year. We're not quite built up in this account. We're only in like week 13 or 14. Let's see where we are in our weeks of building this account up. We are in week 13. So we are here. Week 13. Let me make that blue. Blue. I want it the same blue. There we go. So we're in week 13. We should have on 16 positions. So we'll see if we've got on 16 positions or not. I don't think that we do. We're probably underachieving a little bit. But if the market is down, that's a good time to put on a trade. No, it's still not down. The market's still up on the day. So let's do let's go in and let's see what we need to do with our Greeks and ratios. Now, with portfolio management, ladies and gentlemen, if you're running a options portfolio, there's three things that we kind of monitor. I'm going to go through them quickly today. We'll talk more about them later in class. But the first thing is your delta. And this is a SPY weighted delta. What is SPY? SPY is an ETF for the S&P 500. It's probably the most traded instrument on the planet. It's SPY. And SPY is currently trading at 485. Okay. So that's what this is. This basically says I am holding the equivalent of 289 shares of SPY. So I am in a bullish portfolio. Now, if it said negative 289, that would be the equivalent of me being short 289 shares. Okay. So that's what we do, 289. So we put that in my spreadsheet, 289 over here. So we're not as directional as we were last week. We're only at 289. Now, VIX is 13. We got to record that. Now, let's see what theta is. Theta is the amount of decay that our options have that we've sold every day. So all things being equal, we should make $335 a day. Can somebody say Applebee's?
Well, what do you say we get thrown out of an Applebee's?
Let's all get thrown out. Let's meet over there. It's going to be fun and get thrown out of Applebee's. But I can take my family to Applebee's on $335 a day, y'all. So that's what we should be able to get is $335 a day. So let's put that in. That's the amount of decay in our options, and we want them decay, $335. All right. Now, the last thing is how much collateral we have to put up for our trades. Now, I'm holding a number of different things here. So we've got Bill, that is an ETF that holds the equivalent of Treasury bills, 1 to 3 month Treasury bills. So we're using 306,000 of our 460 something thousand to hold Bill. And then only 130,000 is the broker saying, hey, Bob, you got to put aside $130,000 of this $450,000 account in order to make these trades. So let's just say 130,500 is the amount of collateral we're putting up. So that's gone down. So we're only using 28% of our buying power. We generally don't want to use more than 50% of our buying power so that we have cash on the sidelines to help us with our little trades. Okay, in case something goes bad, we got to manage a position and we need extra collateral. The collateral is there. Okay, now our deal today is we want to have on, what I say, 15 trades is the way we built this thing up. No, we want to have 16 on. Let's see how many we've actually got on. So let's go over here and to our spreadsheet and see how many trades that we've actually got on. So if I go over here, I think this keeps up with it. Okay, we've only got on 12 positions, y'all. We've only got 12 positions on. Now, that's 34 contracts of the naked puts, and that's 17 contracts of the put debit spread. So what we want to do is put on another 112 trade, and let's do it today. Now, first, let's show you the risk profile that I showed you guys the other day, and why we're so excited about this particular trade, because it looks something like this. Look at that. This is the current price of SPY. If SPY goes up 1 standard deviation on the bell curve there, on the normal distribution curve, then we're going to make $18,954. We make $18,000 if we go there, and it doesn't matter if it goes up to the moon, baby. We are there making all kinds of money. And if the market goes down, Big Daddy start making some good money. 26,000, 41,000, there's 54,000. There's $61,000. But then it gets ugly, y'all. If we go way down here, right? We start losing, and it starts losing. You could lose 50 or 100 or 150,000. I don't even want to think about it, but that's a 2.5 standard deviation move down. This is the risk profile at expiration, not today. So if the market were to go down really big now, we actually might lose some money today. But at expiration would be perfectly fine. I know this is a lot to throw on you. You're going to get it, I promise. but we just need to go through it every week. So today I will put on a two tranches of what we call the 112 trade, and we're going to do it in the E-minis. Okay. So let's go to the trading platform. We'll show you the trading platform here. Then we'll show you how to do something in Thinkorswim because that's where your assignment is. So here we go. Got to do a little trade. So we pull up ES and I click on the trade tab and I trade from the table. And where we like to go out is 120 days out in the option. Remember, these are all the expirations you got. So we like going out 120 days. So we could actually go to 113 days, or we could go to 127 days. Both of these are equally close to 120, right? I could go a little shorter. I could go a little longer. I think I'm going to go to the 127 today. Let's do that. Let's do the 127. And we're going to put on a put debit spread. So I'm going to go to the 25% probability of being in the money, which is this one here. Remember how deltas and probability of being in the money are the same? And we're going to buy that option. And then we're going to sell the option or the strike that is 50 points below it. And it looks like we can do that for about $8. Let's move it up to 805. Let's move it up to 805. And let's do two tranches of this. So quantity is 2. And put that in. Ta-da! Oh my God. We got feel good there, y'all. Good. So we got our 2 in. So that's our 1 portion of our trade. Now we want to do the 2 portion of our trade. And that is to go down to a 5% probability of being in the money, which means we have a 95% probability of success, ladies and gentlemen. So we go down to the 4,000 strike. And we're going to do 2 tranches. So this is a 112. So I got to sell 4 of those. All right. We're going to try to get that mid price of $15. And what's this? Here's what we like about this trade, y'all. The probability of profit on this particular trade is 99.5%. Hallelujah and praise the Lord. My maximum profit is $3,000. That's the premium received. And they're charging me $24,000 worth of margin. That's the max loss that the broker thinks that I could make on this trade. Make 3,000, risk 24,000 to make 3,000. Does that sound like a good deal to y'all? If you've got a 99.5% probability of profit, I like it a lot. My max loss is if the E-minis, the S&P 500 goes down to 0, I'm going to lose $797. And y'all won't ever see me again because I'll be running away. All right, so let's hit this. And dang it, we are in, baby. So we are in, and that looks really, 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 really good. And so again, let's look at how our little thing looks. We go to positions, we go to P&L. Again, this is our portfolio, and this is a little better too, right? Now, I'm not sure why it shows. Oh, I guess that's because it may be taken into effect. I don't know what that's taken into effect, why that's going up. But what we really like is this down here, the $60,000 of profit. But look, this one shows, if we were to go down to the 370 area, SPY goes down to 370 area, we're down $147,000. Yay. Okay. But remember, you guys are in your 20s. My class is in your 20s. Now we've got some old dudes in here from our trading group, Trader Nerds, but you guys are 20 something years old. You can risk stuff. It's okay for you to risk a little bit of money to make money with a high degree of success. Okay. Any questions on that before I show you how to sell a put? Okay. The vast majority of you came up with Amazon as your stock to buy. And remember, we told you, why buy stock when you can sell a put and potentially get it at a much better deal? So let's pull up Amazon. So here's how you're going to do it, guys. AMZN, or whatever stock you want to do. You could do Apple or whatever. And it shows you the bid and the ask. You sell on the bid, you buy on the ask. If you were buying stock, that's what you would do. If you wanted to sell it short, you click there, you left click on ask if you wanted to buy the stock. Now, whatever stock that you're trading needs to have at least 1 million shares traded per day. Ladies and gentlemen, Amazon is just fine as a vehicle because it has adequate volume. The number one thing about trading options is you've got to make sure it has adequate liquidity. Liquidity means people getting in and out of it so that you can get out of it once you do your trade. Let me turn the video off so that y'all can, this is not covering the screen. There we go. For when I post the video. So 30 million is our volume. The bid and the ask spread, you want those to be pennies if possible. See how it's 45, 46, 45, 46, 44, 45? That spread is where the market makers make their money on that little penny in between those. And if this were like 25-cent spread, if this was, 156.48 and this was 156, 95 or something, that would probably be a little too wide for you to trade. So I want you to make sure you got a narrow bid ask spread. All right. So this has plenty of volume. Remember, whatever you trade needs to be more than a million shares. This definitely meets that criteria. And I want you to go out to the option expiration that's nearest to 45. So we could go 43 or 50. Let's go to the 50. Doesn't really matter which one you go to. All right. I forget what I told you in the does anybody have it? Did I say sell the 10 delta or sell the 20 delta put or the 15 delta? Anybody have that? You got the assignment? You got to make sure that this says delta. So I'm not sure how yours looks, but if you'll do this, go and click there on whatever's there, go to option theoreticals and Greeks and click on delta. That'll give you the delta. And I also want you to put probability of being in the money. Click on click there, whatever yours says, and option theoreticals and Greeks, and choose probability of being in the money. So that's, you've got to do that to make sure you see the delta, the probability. So if I told you to sell about a 15 delta, that would be either this one or this one. And don't, if you're close, don't worry about it. So this would be delta and probability of being in the money are approximations of each other. So this, we would call this an 11 delta, this a 16 delta, this a 23 delta. I would call this a 13 delta, a 19 delta, and a 27 delta. These are approximations of each other. So if I told you to sell about a 15 delta, you would either do probably the 135 strike or the 140. So what you'll do is you'll left click on the bid. Remember, bid is sell. You'll left click on that strike, 135 strike. And it'll pull up something like this. Now, yours may say it's going to do 100 shares. That's fine. Oh, did it say 30 delta? Okay, we can move it up to 30 delta. So 30 delta would be around here, right? Around this 27% probability of being in the money. So let's do this. We'll do the 145 instead. If this says 100 shares, that's fine, or you can change it to -1, whatever you want to do. This is how many lots that you're doing. Remember, one lot equals 100 shares of stock. So if I'm receiving $2.80 for this, that means that I'm going to get $280, right, by selling this. And then once you click that up, you simply go to confirm and send. And this is the screenshot, ladies and gentlemen, that you want to take a picture of. You want to take a picture of this, a screenshot of this, and then look how easy your assignment is. What is the break-even price? 142.22. That's slightly under your strike price, right? What's your max profit? That's the credit that you receive. Remember, we're receiving the $2.78, so we're getting times 100, $278. Your max loss is the 14,000. What is the actual credit you're receiving after commissions? I'm getting $277.45 because they're going to charge me 55 cents in commission. The collateral or buying power that they require me to put on, because this is an IRA account, they're requiring me to put up the entire amount of the max loss. Now, if yours should be in a margin account, so your buying power effect will be much, much less. Okay? This is how you do it. So you sell that. Now, let's talk about what happened and hit the send button. Now, hopefully, after you hit the send button, it'll come over here and blink green and say, blah, 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 field. It'll say that it's filled. But if it doesn't, click monitor tab and your order will be left in the working order. Okay? So you will cancel, replace that order and make it less advantageous to you. Now, this is a buy order, but forget it. So what you would then do is say, well, instead of me receiving $1.70 credit, make it $1.65, go down in credit, and then confirm and send. So you will penny this down and confirm and send until that thing is filled. What does filled means? That means they accepted your order. Okay. Now let's look at Amazon on a neat little platform here. Let's go to Amazon. This is tasty, but it just looks better, I think. So let's act like we were trading again. Here's Amazon. We're going to go down to, we said the 50 day, right? And we're going to go to, I've already got it clicked on there. We said the 30 delta. So 24, 34 around in there. Let's move it there. All right. Let's look at what this looks like. 145. You have a 78% probability of making a profit. Yay. You have a 90% probability of making one half of the $278. Isn't that cool? It gives you $5.72 of theta burn per day, which means all things being equal on this trade, you should make $5.72 per day. Your max profit is the credit received. Your max loss is if it goes to zero. And because this is an IRA account as well, they're charging $14,000, the full amount of the max loss. But what does this trade look like? Let's see if we can see what it looks like on the analysis tab here. There we go. So here's what she looks like, y'all. See if I can zoom in so you can see it a little better. Yeah, here she is. Look at this. This is the profile of a naked put. This is the current price of the underlying. See this little flag? It's going down a little bit, it's going up a little bit, it's going down a little bit, it's going up a little bit. And this shows you what happens at today, the P&L loss at theoretical today, which will be today's date, right? Make sure this is in today's date. And then the P&L at expiration is $275, the credit received. It doesn't matter if it goes down past your strike, right? You're still going to make money as long as it expires in 50 days above your break even at that 142 and a half. You're going to make a little bit of money. But if the stock goes up, look at there, you make your $276 regardless. If it goes down past your strike and expires below your strike price, what's going to happen? Anybody know? If this thing expires and it expires below your strike price, if the price of Amazon is below 145 at expiration, you are going to wake up the next morning with 100 shares of Amazon at $145. Isn't that cool? Now, it's possible if it goes down, it's possible that they could shoot you those shares before that too, right? That you could be assigned shares before expiration. That could happen. So if that happens, don't worry. But the cool thing is, if you have a client that wants to buy Amazon at 156, you need to say, well, wouldn't you be happy buying it at 145? And if they are, you can sell the 145 strike and get them $278 per one lot. Very, very cool. And you see what happens is your losses start going down. Look, it looks bad over here, y'all. Look at this. Woo! If we keep going down, you lose lots of money. But again, the odds are in your favor. Okay? The odds are in your favor. All right, who's got a question on selling a put? Take a screenshot, upload it, tell me, all those things that we went over, and you should be ready to go. Now, here's another thing I want you to do. Do it in some other stocks too. Don't just do it in Amazon. I want y'all to sell puts in a lot of things. Sell puts in Apple. Sell puts in Tesla. Tesla's down big. Maybe it's a good time to sell something in Tesla. Sell something in AMD. Do something in NVIDIA. Have some fun. This is your account. See how much money you can make this semester. So don't just stop with Amazon. I want y'all to sell puts in a lot of things. Okay. And I would try our deviations based on time. Yes, the standard deviations are based on that same time period as well. The one standard deviation move down. And y'all know what a standard deviation is. Let me see. Let me see if I can draw it. a standard deviation, one standard deviation up and down, there's a 68% or so probability of the price falling within one standard deviation, right? Then I think you go out two standard deviations. Y'all help me. In two standard deviations, like 95% or so. Then three standard deviations is like 97% or so, 97, 98%. Right? Yeah, that's a standard deviation move. So you could kind of figure out that the price of your stock will happen within one standard deviation move. Now, this is kind of cool too. I don't think I showed you this the other day. What's this? And this is the same thing. You'll see the same exact thing in Thinkorswim. But you can tell on the options chain how much they expect Amazon to move. What's this? So in the 50-day, look at this. You see this little thing here? This little gray or little brown bar? This is the expected move. Isn't that cool? So they expect it to go down anywhere from 145 up to about 170. That's the expected move. And isn't this, guys, y'all correct me, isn't this the standard deviation moves on the left side? Well, no, here's the standard deviation moves. This is the one standard deviation move line here. And this is the two standard deviation move line there. Here's the one standard deviation move line above and the two standard deviation line there. And what is this one, y'all? What is this? What is this one? That's not expected move. What is that?
Which one, Bobby? The green one?
Yeah, what's this one right over here,
Yeah,
Victor? What is that?
Yeah, that one tells you when you're profitable. When it's green, if the price goes there, you would be profitable.
Oh, okay.
If
So
it goes up-
this shows you your profit zone and this shows you your loss zone.
Yep.
Okay, good. And what's this, y'all? This is kind of cool. You look out here at the side, and this is the volatility of this particular option chain is 33.4%. And within 50 days, look at this, y'all. They're expecting the price of Amazon to move up or down 12 points. How about that? So you're selling the 145. So that's beyond 12 points, isn't it? 12 points from 156 is what? 144? Did I do the math right? So you're right at the end of that expected move. Isn't that cool? Now, look, if you were to say, how much do you think Amazon will go up within the next year? Well, here's a $358 or 358-day option. What's this? They're expecting the price of Amazon to move plus or minus $35. God, that doesn't seem like a lot, does it? It's not a lot at all. You could say, what about 875 days from now? Well, based on the current implied volatility in the option, they expect within the next one, however many years that is, 2.5 years to go up or minus 58 points. Isn't that really cool? Yeah. Listen, I wish that Tasty had a paper account. I keep telling them they need to have a paper account because I would have all of y'all in Tasty because it doesn't look as good over here. Look, this is just clunky to me, right? Everything looks clunky. Again, you can find that same information. Like here's ES. If you wanted to say in 50 days or so, how much will the S&P 500 move? Look at this. They're expecting a move of 208 points plus or minus. So you could take the current price, 49.05, and go plus 208 points. That's the range that it could possibly be in, or minus 208 points. Isn't that cool? So it gives you some little bit. Remember what I told y'all. I'm not a fundamental trader. I'm not a technical trader. I am a little technical trader. I do a little technical studies, but I am a quantitative trader. So all of this information is here that you can make these wonderful, sound decisions. Any questions before I let y'all go? Okay. If every heart is content, I can't wait to see y'all Tuesday. And my trader nerds, I'll see y'all tomorrow. Y'all have a wonderful day. Bye-bye.